Hello, class, and welcome to my database research project. My name is Fiona Smith, and I am a current intermediate accounting student here at WVU. So let's get started. So I wanted to examine 3 companies in the tools and hardware industry and compare them and how they're doing and try to decide which one's the best one. So I ended up going with Lowe's Companies Incorporated, also known as Lowe's, the Home Depot, and Snap-on Incorporated. So while Lowe's and Home Depot are super well known, super big, I decided to throw Snap-on Incorporated in there because it's an up-and-coming company, and I wanted to see how it did compared to the 2 giants of the industry. And as you can see, Lowe's, Home Depot, and Snap-on all have different colors. And I just colored them differently, and according to like their main kind of brand colors, like Lowe's is blue, Home Depot's orange, Snap-on is red, and that shows up. And I used that template for all of my graphs that I made, so that way it's consistent and it's really quick for you as my audience to take a look at things. So let's get started. Based off of what I knew and what brands I used before I started my research, I believed that Lowe's was the best company. That's what my mom always goes to get gardening supplies, and I always go with her. I've only been to Home Depot like once or twice, and it just seemed like my mom preferred Lowe's, so I was like, okay, Lowe's has to be better. So, but that was my opinion going into this project, and you will see throughout each stage of this presentation that my opinion changes, and I'll use that to help evaluate at the very end how all of these projects stack up. So let's get started. So I want to start out just going over some basic backgrounds for each of these firms. That way you know a little bit more about them before we just talk about, instead of just talking about like random data for these firms you might not be familiar with. So Lowe's Companies Incorporated was founded by L.S. Lowe and started as a small town hardware, sewing, and grocery store in North Carolina. But in 1946, his son Jim and Jim's brother-in-law refocused the company to solely home improvement products. So instead of everything store, it's just home and hardware. And Lowe's has acquired 6 companies, and that includes some of the ones that have been listed. Rona was a pretty big acquisition, as you can see, $2.4 billion in 2016. By the numbers, Lowe's has around 300,000 associates in the United States, had $96 billion in sales in 2021. So Lowe's is, by the numbers, pretty big, and it's been around for a long time. The Home Depot was founded in 1978 by Bernie Marcus and Arthur Blank, and the first 2 stores opened in 1979 in Atlanta, Georgia. Their focus is maintaining their image of a one-stop shop in terms of hardware, not like for Lowe's, how it was hardware, grocery store, sewing. They're more of a, if you need to do something for your house, like we have it. Home Depot's typical store today averages 105,000 square feet of indoor retail space. They've also had several acquisitions, including a whopping $8 billion in 2020 on HD Supply Holdings. According to Home Depot, they are the world's largest home improvement retailer. They have over 2,000 retail stores all over the world. They earned $157 billion in revenue in 2022, just this last year. They have over 500,000 associates. That's actually worldwide, so I'm not sure how that compares to the 300,000 in just the US, but still pretty on par with Lowe's in terms of employees. And next, let's go to Snap-on Incorporated. It was founded in 1920 when Joseph Johnson and William Seidman pioneered the idea of the snap-on wrench. So instead of having a wrench with 50 indentations, their wrench that they came up with only had 5, and that was apparently more powerful. So that's where the 5 do the work of 50 saying came from. Snap-on is more than 65,000 SKUs in their product line, operates in over 130 countries, and employs approximately 12,600 people worldwide. So definitely it's on a smaller scale than Lowe's and Home Depot, but like I said, it's on the up and up. It's also had some acquisitions, and while its biggest one wasn't in the billions, $155 million is still a lot of money. And then I included some of the brands that they've acquired or that they started themselves as the graphic for this slide. So, based off of my general company research, at this time, while I was in the process of doing this project, I thought, hey, Home Depot is, by the numbers, the biggest company, and it has a nice vibe. Like one-stop shop, that sounds really nice. So, at this point in the project, I'm thinking Home Depot is the best one. So now let's head to some general ratios. These will help give us a little bit more insight into the company and see a little bit more about how well they're managing their resources. So the current ratios of firms shows how assets compare to liabilities. And that's how I found these numbers. Current assets divide by current liabilities. And this is expressed as a whole number and not a percentage. So it's a ratio, but we don't want to see a percentage. It's just easier to see it as a whole number. So a current ratio of 1 or more means the company has more assets than liabilities. Therefore, it could pay off those liabilities with its current assets if it had to. So let's take a look at the chart. In 1981, Home Depot was far and away had the best current ratio, but since then, Home Depot's definitely tapered off, and now it seems like Snap-on is on the up and up. So I'll give you all a minute to take a look at the graph. Okay, are you ready to move on? All right, let's see what's next. So for working capital of the firms, I found this by subtracting current liabilities from current assets, and working capital is also known as net working capital, NWC, and this is a measure of a firm's liquidity and short-term financial health. So if this number is positive, that means that a firm can fund its current operations as well as invest in future activities and growth. So if it's a positive number, especially a big positive number, that means good things. So the current ratio, which we just saw on the last slide, is the liquidity metric for investors. That shows investors as well as people in the public how well a firm can convert its resources to cash. Working capital, which we see on this slide, is the liquidity metric for management. So that shows management how well they're doing. Is there something that's bringing the firm down? Do they need to do anything differently? This is just for management's purposes, really, to see how they're doing. But I wanted to look at both of them because I think they both working capital adds on to my thought process from the current ratio and just kind of is a second proof to that, if that makes sense. So as you can see, in 1981, everyone was positive, but no one was really doing really well. As they say today, popping off. Starting 20 years later, though, once we get to 2000, everyone is definitely over the 500 mark. I mean, look at Home Depot. It's over 2,700. And then 2010, Home Depot and Lowe's continue on the rise. Snap-on stays in about the same place. But skip forward 12 more years, and this could have been due to COVID, but Lowe's and Home Depot drop right down, but Snap-on continues its rise. So like how we saw with the current ratio with I think actually on this next slide I compare the two. There we go. So I don't have to go back to the previous slide. I have them both right here. So like how with the current ratio, Snap-on towards as we get closer to now, Snap-on continues on the up and up, whereas Lowe's and Home Depot kind of taper off and decline a little bit. We see that happening with working capital too. As we get in the last 10 years or so, Snap-on rises, booms, and Lowe's and Home Depot kind of fall. So I just wanted to throw working capital in there because that kind of shows a little bit more detail to what we saw in the current ratios. So, like I was saying, I think right now, just looking at these things for general ratios, I think Snap-on is doing the best in this section. But now let's take a look at activity-based ratios. Things could be different. Here I have the average asset turnover ratio. This shows how efficiently a firm is using its resources to generate revenue and sales. I found this by dividing net sales by total assets. So by comparing a firm's gross revenue to the average number of total assets, it reveals how many sales were generated from every dollar of company assets. So not just looking at how like gross profit ratio where you're seeing how much money you're getting off of the inventory. This shows you how all of the assets are affecting the income for the company. So the higher the asset ratio, the more efficient the use of the company's assets to earn money for the company. So we kind of see a similar trend from before where people start high in the 80s and then kind of slow down as we get closer now, except instead of Snap-on doing really well, it's Lowe's that's still staying really high. So in 1980s, we see everyone above a 1, which is good. And as we get closer now, we see that Lowe's is at 2.1, which is still really good. But Snap-on and Home Depot fall below 1, which means that total assets is greater than net sales. So that's showing that they're not making more money than what they currently have in assets. I'll give you a couple seconds to look at this graph. Okay. All right. Let's see what's next. So average days in inventory, this is more for a managerial standpoint. This helps firms plan when to order new stock and shows essentially how long it takes each firm's inventory to be sold. I found this by dividing 365 days by the inventory turnover ratio. And the inventory turnover ratio is cost of goods sold divided by total inventory. So over here on this 100% bar chart, I did out of 100% so you could more easily see how the data fits together instead of just 3 columns per date. I wanted you to be able to see how, since everything's adding up to 365, basically, I just wanted you to see how it fit together. So in 1982, Home Depot and Snap-on definitely took them a while to sell their inventory, but Lowe's was clearing it out pretty quick. But then, as we get closer to now, we see that Snap-on still holding onto its inventory for a while, but Home Depot is clearing out pretty fast, and Lowe's is holding on to it a little bit longer now. So it's interesting to see it change over time. Why did I focus on the asset turnover ratio and average days in inventory? That's because these metrics provide important insights into a company's operational efficiency and profitability. And by this, I mean it's a good view into how companies manage their inventory and generate revenue. The asset turnover ratio measures how efficiently a company is using its assets to generate revenue. But on the other hand, the average days in inventory ratio measures how long it takes for a company to sell its inventory. So, just to clarify, a high asset turnover ratio paired with low average days in inventory suggests that a company is super effectively managing its inventory and assets and selling their products quickly and generating revenue more effectively. So, now that we know how these things relate to each other, let's take a look at both of these charts together. So when we're comparing the asset turnover ratio to average days in inventory, we see that Lowe's was having a really good asset turnover ratio the whole way through, and it had okay time selling off its inventory. So Lowe's, I would say, is doing pretty well. Whereas Snap-on and Home Depot, not so well, especially when we look at both of these graphs and we see that they're both kind of low in the asset turnover ratio and kind of big in average days in inventory. So I would say Lowe's is back on top. It really killed it with the asset turnover ratio, and the average days in inventory was relatively low compared to the others. So I'd say that Lowe's in this section definitely was number one. Now let's take a look at profitability ratios. So the average profit margin on sales is expressed as a percentage, and that is your business's profit margin over a period of time, usually a long term. Now remember, a profit margin is how much money you make off of whatever you're selling and taking out the cost of selling it. So I found the average profit margin on sales by dividing net income by the average total assets. And I want to clarify for my data going forward, because I end up using a lot of average of something for the ratios. For my calculations on the tables that I made so I can make the charts, I took the beginning of the year, added the end value of the year, and divided that by 2. And the beginning value of a year is the end value of the previous year. So let's take a look at this chart now that we understand it a little bit more. So all of them definitely have their ups and downs, but if we look at the dotted lines, which are the trend lines, we see that Home Depot is definitely going up a lot more than Lowe's or Snap-on. And Home Depot also starts higher up on the y-axis. It is a higher y-intercept. So I would definitely say that Home Depot definitely did really well. And comparing Snap-on and Lowe's, even though Snap-on started in 1980 a little bit higher than Lowe's, you can see that its trend line is a little flatter. It's a little more stagnant, but Lowe's definitely had a lot more growth. So that's that tidbit for you. I'll give you a second or two to look at it just to make sure it makes sense. Alrighty. So the average return on equity, also known as ROE or ROE, is a measure of financial performance. So because shareholders' equity is equal to a company's assets minus its debts, ROE is considered the return on net assets. So I found ROE by dividing net income by the average shareholders' equity. ROE is considered a gauge of a corporation's profitability and how efficient it is in generating profits. So the higher the ROE, the more efficient a company's management is at generating income and growth from its equity financing. So when we take a look at the graph over here, we see that in 2010 they're ending up kind of around in the same place. But let's take a look at these trends. So Home Depot and Lowe's both start at 20%. Home Depot definitely decreases, but it doesn't decrease as much as Lowe's does, because Lowe's goes all the way down to 10%, but Home Depot kind of chills at 15% in 2010. Snap-on is the only one of those of the three that from 2004 to 2010 that is a positive slope. So even though it is increasing, it's definitely not increasing enough to really beat out Home Depot. So that's pretty interesting. But I'm going to show you this graph. I'm also going to add in the data from 2022. I just wanted you to see how these trended from 2004 to 2010, because the 2022 data gets a little crazy. So, as you can see, in 2022 or 2023, Home Depot goes up to 2,000%, and Lowe's goes down to negative 500%. So, as we remember from my prior explanation, a higher ROE means better things. So Lowe's going down to the negative like that, not a good sign. And now I just want to clarify that Snap-on is not at 0% because as we can see in the chart, it's 5% up to 15, and in my table I can tell you it doesn't drop down to 0%. It's just because of the scale of the graph, it just looks like it's not moving. So Home Depot definitely shot up. It's definitely doing really well. Snap-on is still doing okay. Lowe's definitely right now is not doing all that fabulous. So now let's compare these two charts. So the profit margin on sales, remember that's also the higher the ratio, the better things are going. So Home Depot is definitely doing pretty well on that. It was trending high. It was starting high. It's high right now. Snap-on kind of stagnant on that. Lowe's was doing okay, just not as good as Home Depot. But in the row, Home Depot far and away doing the best. Snap-on still doing okay, but Lowe's definitely was not doing well in that. So, in review, in this section, Home Depot is definitely killing it in the profitability section. It's doing super well, super well. Now, let's take a look at our last little section on leverage. So let's talk about the equity multiplier, also known as EM. It is total assets divided by the average total equity. And we found the average total equity already because that is rho. So a higher EM typically signifies that the company is using a higher ratio of debt in its capital structure to finance working its capital needs and asset purchases. So the higher this EM is, the more debt and liabilities they're taking on because they need more cash right now in order to pay for the things that they need right now and to increase their firm for in the future. So the higher EM means a higher reliance on debt financing, and that also means a higher credit risk. By contrast, a lower multiplier means that the company has a lower reliance on debt, therefore reduced risk. But that's kind of only really for a lower positive number for the multiplier, because when a negative EM happens, the firm is not generating money, so more debt is acquired to fund the operation, which then means liabilities are greater than the assets, producing the fact that the equity will be negative. So when we say a low EM is best, we don't really mean a negative EM. We just mean a low positive one. And as we can see in this chart, Home Depot is super high up there. Lowe's is really trending downward, super negative. So that means both of those are using a lot of debt to finance their firms. And Snap-on is definitely just having a good time, not using a ton of debt to finance everything. It's doing well. So at the end of this leverage section, I would say since Snap-on probably has the lowest credit risk, just going off of the EM, it's probably a safer bet. So now let's get ready to answer the big question: which firm is the best? And to help you with that, and also help me with that decision, I went through, and on top of the number one rankings for each of the sections, I also went through and ranked the other two. So you can see that, remember, number one is the best, and number three is they placed last. So you can see that it was pretty fair throughout. Everyone got a little bit of something, and instead of making you have to add up, just looking at this chart that's going up and down, I also made a table on this next slide. And as you can see, everyone got every position twice. So just looking at the ratios that I did, everyone ended up being evenly matched. There were a lot of pros and cons. So I just had to make a decision just on my own preferences. And I decided that I would invest in Snap-on since it's a great company like Lowe's and Home Depot, but it still has a lot of room to grow. So that means the stock prices will probably be going up. So if I invest now, that will make me a lot more money than if I invest in Lowe's or Home Depot, which are already like at the top of their game. Also, Lowe's and Home Depot are great, but as we saw with the EM, their dependence on debt definitely concerns me. So, Snap-on wins. All right. So I'm just about done with my presentation, but I definitely wanted to put up my references so you can see that I didn't come up with all this information on my own. So here's the first of them. And here's the last of my references. All right. Thank you so much for attending my lecture. I hope that you learned a little something today. Thank you.